Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. We're back on Mondays. It's been a while, but here we are. I mean, you wake up on this Monday. We're in the middle of December, but this is market call 1 p.m. on the East Coast. Guy Adami, Dan, Nathan. It's amazing. It's like you wake up and it's Christmas.
Really?
It was just November. I mean, it's nuts.
Really?
Feels like
what
that.
What is the
4th. I mean, think about that. It's crazy.
Yeah. What is the letter in the futures pits for December, guys?
Z. So
October.
Yeah, we've talked about this. October is a V.
Yeah.
But when in the course of trading down there on the exchange, when things are moving quickly, the V's and the U's start to look alike. So the smart guys and gals down on the Merck made October an upside down V. That being said, November is Z. As you have mentioned, Z is dead. Who's Z? The whole thing. Anyway, It's interesting. We're going to talk about a lot of things, but let's look at the rundown because it talks about gold's breakout. Well, not so fast because the reversal is incredible. Big tech is selling off, and that's been happening since the Nvidia report. And Dan Nathan is going to put forth an options trade in Toll Brothers, which had a huge move to the downside, only to have a subsequent move to the upside, seemingly all on the back of bond yields. But here we are, Dan.
Yeah, we are. And we got to talk, if we're going to talk about your gold guy, we got to talk about Bitcoin, man. Like this Bitcoin is kind of moving its way back. It got to like 42,000 or so today. And our friends over there at the CME group, or just CME group, they're going to launch one of those trading challenges again. It's going to start on Sunday. It's a crypto challenge, a crypto classic. So go there, sign up. You know what to do. In this last one, guy, that we all participated in, they had thousands of people trading on their, paper trading on their system and learning about the underlying products and the like, and how to use stops and all that sort of fun stuff to trade these sorts of products. So definitely check that one out. We are going to be participating in that. And what's interesting, guy? Do you remember in December of 2017, Bitcoin was in this huge retail frenzy back then? This is long before all this NFT crap and all the, stuff that went on in 2020 and 2021. And, CME Group introduced futures, and it was like literally within, I want to say, a few trading days or a week or so, that was the top. All of a sudden, CME Group offered up a product where folks who are invested in this asset, if you want to call it that, right, had the ability to finally hedge it. And that was it. You know what I mean? Or speculate using somewhat defined risk and everything like that. So we'll spend some more time on that. Maybe we'll get somebody from the CME group to come on the market call and discuss a little bit about how futures are trading. And one of the things that's interesting about crypto and Bitcoin in general right now is all this excitement around spot ETFs is causing demand for the underlying. And that's been going on now since it bounced off that 200-day, about 2 months ago, since some of these reports came out. I mean, look at that. I mean, that has just been a straight shot up from what? It's nearly doubled or so in the last 2 months.
It's pretty remarkable. And I think the time frame you mentioned, I want to say, if I'm not mistaken, Bitcoin went from like 8,000 to 20,000 or so in December of that year, only to give most of it back. So, I mean, we're not saying that's going to happen now, but it's just an interesting sort of look back in time. But, you mentioned the spot ETF being announced and all those different things. Also, we bounced off the moving averages clearly, but in large part, I think this was due to some of the rhetoric we've heard from central banks. And don't dismiss the fact that, you probably have 4, if not 5 rate cuts priced in next year. And as those rate cuts started moving forward and adding more, I think that's when you've seen Bitcoin take off as well. So I've always thought it's a play against central banks, and it's proving to be that, I guess, right now.
Yeah, well, listen, you've been saying that for years now. Actually, in that long bear market that we had, when it was coming back out, you always thought that would be the way to play it. You've obviously been steadfast with that on gold, so we'll hit that in a little bit. But here's an article in the Journal, guy, over the weekend. I thought this was interesting. It was talking about goods deflation is back. You could speed inflation's return to 2%. And you just look at that graph right there, and you see that services is still well bid, but you see some of the other stuff, the durable goods, and we've been seeing weakening orders than that. And so this kind of tracks what we've seen in China too, Guy, in the post-pandemic sort of situation. But again, I mean, I'm just bringing this up. You and I don't have to debate it. This is what is being talked about, among the circles of economists and strategists and the like here. And a lot of folks feel like this is one of the reasons why we're seeing those rate cut expectations being pulled forward fairly dramatically. I guess the situation that the Fed would be in is that the inflationary readings did start to come in really hard, then their policy on rates would be too restrictive, right? And that's really the whole game right here.
Yeah, I would, yes, and I think I'd feel a lot better about things if that services number was going the same direction, but it's actually going the other way. So look, I mean, we can it depends on one's dogma. You can look in this and say this is great for the Fed. Others will say, you know what, it's still a problem on the services side. I get it. The ultimate arbiter, obviously, is the market and the move in yields. I mean, where do we get down to? Do we get down to 4.18 or so, or 4.20 in 10-year? And that's what Carter Worth has been saying for months. He thought 4.15, and basically you got there. So it's hard to game out the bond market right now, especially when you start to see graphs like this and some of the rhetoric we've heard for next year.
Yeah, no doubt. Let's pull up. We have a chart of the 10-year U.S. Treasury yield. I put a few lines on it. You see the uptrend that it broke just a few weeks ago here on its way. It was probably just below 4.35 or something like that. And you see that sort of support level that we're kind of banging around. I think that was probably one of the things that Carter's eye used to see. You can see this thing. I mean, listen, that 200-day is rising, right, Guy? I mean, it's going to probably get into that support range in the not so distant future here. And might that be a level to at least consolidate a little bit? But if the data continues, right, the way that we just described, in a way pointing towards inflation coming in harder, you're going to see the 10-year, you know what I mean, like kind of find some footing a little bit here. And I guess the question is, and Carter's been on this, and we'll talk to him a little later in the week in Market Call, and you've been saying this too, just from a fundamental standpoint. I mean, at some point, if rates are going down because the economic data is weakening, at some point that won't be great for stocks. And we can pull up the S&P 500 here, which clearly, stalled out a little bit at that prior high from July, Guy.
Well, that makes sense. You've been outlining that level for quite some time. And I'm first of all, I want to be clear. I am absolutely surprised that we got here. With that said, and we talked about this last week at length, finally we filled that last remaining gap to the upside in the S&P. So all that remains now are about 4 or 5 downside gaps that I think extend pretty far back. So that's just something to keep in mind. And you're right to point out where we stalled at levels that we obviously saw this past summer. So, and then you can say, well, it's a much different rate story then and a much different environment. Yeah, it was. I mean, there are a lot of things that have changed, but what really, I think, concerns me a little is the speed with which from late October till basically now, we had that, was it an 11% move or so in the S&P, which is, it's great if you're long, but again, the speed with which we got there should be somewhat concerning.
Yeah, and let's pull up the NASDAQ 100 here, because I think the NDX is also fairly instructive, because the stuff that's leading to the downside in the last couple of trading days is the stuff that led to the downside from the highs in July. And it was a lot of the mega cap tech stocks. And last week, we did say that while the S&P had not made a new real closing high, the NASDAQ 100 clearly did, right? And that consolidation seemed fairly bullish on a relative basis. But here we are, we have one trading day where, we have Apple down 1.5%, Microsoft down 1.5%, Google down 2%, Amazon down 1.5%, and that's how you get to, a NASDAQ looking like, or a NASDAQ 100 at least, that wants to go for that gap, like that gap from last month or so. So to me, I think it's important to point out the differences. We know that in the NDX in particular, these top 10 stocks make up 50% of the weight. We also know that there's been this kind of broadening out a little bit, like a dash for trash, Guy, in a bunch of much more smaller cap names. But you can have a bunch of small cap names or smaller cap names up 5-10% a day for, a few trading days. But when you have those top 7 to 10 down 1 to 2%, it's just not going to make up for the losses that you're having in the mega caps.
Right. And just to push back on that, and the bulls will correctly say that, everything you said is correct, factually correct. I mean, just look at those names, anywhere from 1.25% to 2% down. And they are obviously, in terms of market cap, very large names. Yet the S&P 500, last I looked, is only down, 0.6%. So you have this outperformance. Again, if you had told me Sunday night or over the weekend, Guy, all these stocks are going to be down anywhere from 1.5% to 2%. Where's the S&P going to be? And I would be like, it's got to be down 85 to 100 handles. And that's not hyperbole. Yeah. That's just sort of what the math suggests. And that's not happening at all, which I guess should bolster or reinforce some of the bull's thesis.
Yeah, let's flash up the Mag7 here. We have just kind of a listing of them by market cap here, and it's just truly astounding. I mean, when you look at this, again, I mean, I don't call them the Magnificent. I call them the Mag. I like kind of like MagSafe. You know how you charge your iPhone, Guy? You use the MagSafe charging. So we got the Mag7 here. And again, I mean, look at those fabulous gains. Might we have a situation here where some folks are starting to kind of question the concentration? I don't mean like, listen, there's always concentration in these market cap weighted sorts of things, right? But right now it's a combination of valuations, a combination of unusually positive sentiment around a secular shift that really saved the market this year. And maybe these guys can flash this up too, Guy. On the cover of Barron's was, the AI gold rush. That was it. I mean, like, can we bookmark that? We just want to be clear here, people on the market call. We're going to book that. And then you see the article about Microsoft that, it got an AI boost. It's far from over. I mean, when you start seeing these sorts of headlines, and now let's kind of toggle back to the market caps of these companies and the year-to-date gains. Guy, what do you say to yourself? You say, well, anybody who's bought these things is kind of all in, and now it's a bit of a put up or shut up, which also brings me back to the July highs, right? When we had a bunch of pricing announced for a lot of the products and services that these companies were going to, announce or start to ship or commercialize. And then we also had quarters that had guidance that maybe felt as good as it gets, if you will.
Take a look at that chart, or that if you go back to the Barron's. I mean, good for Barron's for using Microsoft colors in the font of. I mean, it's so, yes, I do like it, because to your point, if you ever wanted to sort of bookmark something, that's one you want to bookmark. Just keep that in mind. In terms of the importance, again, we've said this dozens of times. They become their own asset class, and if you think about the number of ETFs and funds these stocks find themselves in the world of passive investing, regardless of news, the funds that go in are going to bolster these names. And that's what we've seen. And not to take away from these companies, we've said it many, many times as well. Some of the most important companies in the history of mankind. Microsoft, probably one of the top 3 or 5 most important companies in the world. Nvidia, a great company. Our concern has been the valuation that the market is attaching to them. And I think, quite frankly, if they were to be honest, they're probably somewhat concerned with their valuations as well. So it's not an indictment of the companies, more so an indictment of the valuations that the market's attached to them.
Yeah, no doubt. Let's pull up the Nvidia chart for a second here, because it's down about 10% or so since that kind of recent high that was right before earnings. And again, I mean, we've talked about it, like listen, make no mistake. This stock is consolidating here. It's a $1.2 trillion market cap company, and it's consolidating because the eye-popping beats and raises, they're in the rear view mirror now, right? So then if the Barron's article talks about valuation and that it could grow further into that valuation, that's fine, but just understanding that getting 50% beats, of guidance, that's gone. Those days are over, you know what I mean? And then if you think of some of the commentary from the Commerce Secretary, Gina Raimondo, what she had to say, and like you and I have been reading these headlines about these workarounds for these chips. You are a U.S. chip company, right? And you buy into some of the issues as it relates to national security, right? You know what I mean? The idea of tweaking a couple things so you can sell your super chips, your graphic chips, to our biggest known rival in this space. And listen, the countries that harness this technology, I know this sounds like sci-fi-ish and everything like that, are going to own the future. Like, that's just a fact. And by all accounts, the U.S. and through our supply chains and our relationships with the makers of the best technology have probably like a 7 to 10 year lead over the Chinese. So if you're a U.S. company and now you're the CEO, you're Jensen Huang, who's a Taiwanese national, and you have, one of the wealthiest people in the world benefiting from this move in the stock market. This is what's been afforded to you by shareholders, not a state-owned enterprise in China, but by shareholders, in a capitalistic society. And you're coming up with little tweaks so you can sell more product to China. Like, what does that mean to you, Guy? Does that make
Yeah,
some
well,
sense?
well, it doesn't. It makes zero sense. And you say little tweaks, and I know you're saying, but quite frankly, they're pretty massive tweaks because it's such a massive end user
Yeah.
that they need to service. So the fact that Gina Raimondo called them out, and we'll put that in the show notes because we actually were sending that around, I think, last night in our group text. I mean, that should be a bit of a wake up call. And the language that she used was rather stern if you go back and listen or read it. And Nvidia themselves has pointed out one of their existential risks to the company is a geopolitical risk associated with China and Taiwan. So I think you're 100% correct in pointing it out. It's somewhat hypocritical of these companies. It's amazing when President Xi came to San Francisco, how many of these CEOs basically made beeline there to greet him and kiss the ring. And you can say whatever you want, and they're beholden to shareholders. I get it, but there has to be some sort of greater good. At some point, somebody's got to sort of put a stake in the ground and say, you know what, we're not going to cross this. And for whatever reason, these huge multinationals are reluctant to do so.
Well, listen, it goes back to something you and I talked a lot about, and Danny, on the Tape podcast, earlier this year, the precedent that was set by U.S. multinationals when Russia invaded Ukraine. What will be the precedent if there's an economic blockade? I mean, Nvidia relies, for a whole host of production of their chips in the supply chain in and around Taiwan. Again, if there is an economic blockade or something like that, I mean, this company, you'd think that they'd want to be on the right side of this, like
the right side of history. Well, you're right to bring up Russia, Ukraine. We talked about it at the time. And I want to be very careful here. We're looking at through the lens of stocks and companies and markets, right? So just let's be clear. But when Russia invaded Ukraine, it was relatively easy for these multinationals to say, hey, we're getting out, because it meant nothing to their bottom line. Obviously, Russia is an afterthought in terms of what it means to those companies and their revenues. Obviously, China's a much different story. So once that precedent was set, as we talked about at the time, in order for them to be consistent, you would have to do the same thing. God forbid something were to happen between China and Taiwan. And it's going to be interesting to see the mental gymnastics that are going to take place if and when that does happen.
Yeah, and so let me just make one more point about this Nvidia chart, guys. So the 50-day and the 100-day, they're not on this chart, but they are basically right where the stock is trading right now. They basically flatlined also, and that's consistent with the fact that the stock, since that huge gap to 400 back in early June or so, it's consolidated between $400 and $500. There is a moment of truth coming. That rising 200-day is going to be at that uptrend in the not so distant future, right? And let's see how this stock acts at technical support. And again, there's a lot of people who believe that there's a lot more runway, that exists for the opportunities in this company. But who knows what's going to happen from a geopolitical standpoint? Who knows what's going to happen here in the US and what sort of pressure is kind of put on them? And I think there's a moment of truth coming at that uptrend. It's probably about 415. You've talked about that gap. That's, 300 to 370 or something like that. I suspect at some point in 2024, that gap is going to be filled in. I'm just, maybe it comes from higher levels. I have no idea. But as soon as we go, the estimates go X growth, meaning you know what I mean? So we had these crazy, beats and raises. That's probably when investors say, okay, well, let's let this thing consolidate between 350 and 450, because then let's see how this technology plays out. Let's see what happens geopolitically. Let's see how our customers who are competing, who are buying our product, but also creating their own chips at cheaper rates, and what the adoption is of the software and the ecosystem in around their graphics chip. It's just a lot of stuff that basically has been anointed to them already. And I'm not railing against it. Again, great company, but I think they got more challenges in 2024 than they had tailwinds in 2023.
Before we go to our next slide, I think the guide, I think it was 2 quarters ago, in revenue from 7 billion to 11 billion in terms of percentage guide. I think that's going to probably be the peak for quite some time. I'm not talking about absolute dollars, because I think the latest guide was from 18 to 20. But to your point, those guides, I think, have sort of peaked in terms of percentage, and in terms of potentially on the other side, when you start to see the flattening out, that's when I think you're going to have to be concerned, and that's when valuation is going to matter.
Yeah, and just one more name that I think is attached from a sentiment standpoint in a lot of ways is Tesla, and I just want to throw this one up here too because the stock is, listen, there's a lot of excitement around the Cybertruck release that happened on Thursday. Obviously, Elon Musk in his interview on Wednesday with Andrew Ross Sorkin at the Deal Book kind of overshadowed that a little bit, and interestingly enough, most of that conversation, and you were listening to, was about Twitter, and it was about, you know what I mean, like a lot of views that he has in and around that. But it seems to be kind of weighing a lot of stuff that I read over the weekend is like, if you were a true believer in the Tesla story and EV adoption, and you love the innovation out of Musk, this Cybertruck was your wet dream, right? But a lot of this kind of overshadowed was overshadowed. And when I look at this chart here, and I say to myself, and we've talked about this, like the last 3 quarters that they've reported and guided, the stock has sold off 10%. Because they did not like the delivery number, the margin number, and the guidance, right? And so now all of a sudden you're starting to see some of the sentiment around the CEO of this company kind of weigh on the stock. Now, the stock's had a nice little run, right, over the last kind of month or so. It's doubled the performance of the S&P or so. But I just kind of feel like and I have this Troy Test-like. This is a guy who's got a Patreon and he tracks deliveries. Listen, let me just tell you something right now. This is happening. And this guy is not like, I don't think he's a bear by any means. If anything, he leans bullish, but he's more tracking the data both here, Europe, and China. I mean, the wait times are declining. The backlog is declining, okay, for these sorts of things. And inventories are going up at a time where pricing is going down, with competition in China in particular is like really difficult, okay? So there's a massive price war going on. And then think about all the geopolitical stuff. And again, Andrew Ross Sorkin did ask Elon this question about the leverage that the Chinese possibly have over him relative to multiple different businesses. Shanghai is 25% of their production right now, and it's supposed to go higher. And it's really important for them, right, to have access to Chinese consumers, access to rare earth materials. So this chart, keep a close eye on. That downtrend, guy, pretty evident here. That uptrend, obviously pretty powerful, but it seems like it's kind of at a time where the fundamentals are not particularly great. It seems like this one is something to keep on your radar for a broader sentiment standpoint as it relates to the NASDAQ.
Yeah, a couple things. A couple of weeks ago on Fast Money, you pointed out that when fundamentals matter around the stock, and typically it's around quarterly results, or some sort of unveiling, the stock typically goes down. It goes up in sort of the wake of that, when then the emotion of the market seems to carry the day. But with all that said, at current levels, this stock has vastly underperformed the broader market since the fall of 2021 or December or January of 22, when the stock probably was making an all-time high. It's just something to keep in mind. We get seduced by this move from 108-ish up almost to 300, and you say that is Tesla. The reality is, if you go back a couple of years, this has been in a pretty significant downtrend for the better part of 3 years.
Yeah, well, I mean, listen, they can pull up a 5-year chart. I mean, the stock in December of 2020, guy, entered the S&P 500 at about $234. That's basically where it's trading right now. Now, it did go, at the end of 2021 up to those, 400 or something like that. This is the mother of all head and shoulder tops, in my opinion. I know this is one that our friend Doug Cass has called out too. You can just see what's going on. And I want to kind of pick one point. See that V reversal that we had from December of last year and then up, early last year, that fell off a cliff in December of last year because it was like the first price cut that was happening, the first of many. And a lot of investors were really worried about those margins as they started to come down off of a mid-20 sort of thing. And that happened. So take that out. Okay, fine. You know what I mean? That was a panic. And then you have a situation where, I mean, this stock, based on the current fundamentals, in my opinion, if they have to ratchet down the growth rate of their 2024 deliveries at a lower margin, it's not going to be good for the stock. I mean, the stock, in my opinion, will likely go back to 150 if that's the case when they report in late January. So, who knows? Elon seems to be in a very honest mode right now. The other day, he said that, listen, Twitter could go bankrupt. You know what I mean? So maybe he'll be a bit honest. Listen, they have been giving the appropriate guidance. You know what the problem is, guy? The investors don't give a shit. Like they keep buying it for, you know what I mean? Like that's the point. And, our friends Porter and Vinny over there at Seawolf and Danny talk about this stock. If it were ever to actually trade on fundamentals, it could not trade anywhere near it is. So, I mean, listen, I don't mean that to be a rant on the company. It's more of a rant on investors and what they are willing to kind of like participate in an environment like this.
Yeah, I mean, forget about Elon Musk for a second. Forget he exists. If you just look at this chart, I mean, you're in a pretty, you can see it. Your eyes can see it. Now, folks have been with us long enough to see there's that downtrend from, again, the fall of 2022, or excuse me, the fall of 2021, as we pointed out. You can see the line we can draw it for if you want. And then you can see the uptrend from earlier this year, and that pennant formation. Obviously, the ranges have been getting smaller and smaller, which makes sense. We've been hovering around the moving average, which is flattening out, which makes sense. When fundamentals matter, as you pointed out, the stock goes down. So stay tuned for this one, because most importantly, as you also mentioned, I think this has taken sort of the crown away from Apple in terms of being, and maybe again, Nvidia is right there with it, but being a huge market sentiment indicator.
Yeah. Well, listen, from those 2021 highs to the lows, early this year, that stock sold off 75%. Just think about that. Okay. Like, so it was over $1 trillion in market cap and it sold off 75%. You know what else sold off about 70% from those highs in late 2021, okay, to its lows late last year, was also Nvidia. Okay. Just think about that. Okay. Oh, here's another one that sold off 75%. This is Meta. Remember in late 2021, the company changed its name and people couldn't be more excited about VR, AR, and all that sort of stuff. That stock sold off 76%. So I guess my point is like, it's just amazing how short people's memories are and what that kind of felt like for all of 2022. So we're just bringing it up. It can happen again, people. All right, Guy, we spent some time talking about yields. This week, Toll Brothers, okay, a home builder, a high-end home builder, is going to be reporting. The stock is up 76% on the year. It's trading at an all-time high. Okay. And you just mentioned it when we started the show. It's been definitely volatile over the last few months. It's had a lot to do with yields a little bit. Talk to me a little bit, the implied move in the options market. So it reports tomorrow after the close. And the implied move in the options market, about 5% either direction. You see that near parabolic move, the consolidation over the last couple of weeks, the new high over the last couple of trading days. Give me a sense of your thoughts on kind of just the housing market. We know there's a lot of weird dynamics, but could it be that easy? I also have a chart. Maybe they can flash this one up. This is the 10-year yield, okay, versus Toll. And I think this is kind of pretty telling too, right? You saw the yield get to 5%. Toll Brothers was in the throes of a 20% sell-off. Yield comes in 5% to 4.25%. And here we are. We have the stock up 30% at new highs.
All right, so let's put the Toll Brothers chart up real quick. To your point, the enthusiasm, this stock was full. Let's go back in time. We had been bullish to home builders for quite some time into the summer. And all along we said there's going to be a point that yields get to on the upside where these home builders aren't going to like it. And as it turns out, you can go back and look, as we approached 4.5% and then subsequently went through to the upside, that's when all the home builders turned to the downside. And the move was dramatic. And it continued until you saw this recent cratering of yields. And then it's gotten it all back and then some.
Yep.
So it's clearly driven by yields, but the speed with which, again, these stocks have rallied, sort of again saying, you know what, we the investors, traders, machines, whatever it is, we want to be ahead of these 4 or 5 rate cuts next year. That's what this stock is saying. This is a play for rate cuts in 2024, which may or may not happen. I'd be concerned here if I were long this stock into earnings, because throw out valuation. Valuations don't matter for home builders. It's foolish to even look at it. What you have to take into consideration, I think, are the leading economic indicators, which have basically been going sideways to lower for the better part of 19 months. Go back and listen to the podcast we did with Lisanne Saunders a couple weeks ago. And, oh, by the way, the most important one being the unemployment rate, which I know is still historically low, but has clearly started to tick higher. And I'll say this, I think people are going to be surprised by how fast it goes from 3.9% to somewhere between 4, 6, and 5%. So I would be leery of being long home builders here.
Yeah, me too. And I just look, I kind of looked at the options in this one, and I was looking at implied volatility, the price of options. They're actually fairly elevated. This is kind of unique for a stock that's trading at an all-time high like that. Now, granted, it is in an earnings event where the expected move, as I said, is about 5% in either direction. But I want to look down, guy, like you. And if you own this stock, maybe you could look at a put spread for protection, or if you wanted to make an outright bearish bet. I think the options line up pretty well. Today, when the stock was trading around $88, I'd look January expiration, I could buy the January 85.75 put spread, paying about $2 for that, buying one of the January 85 puts at about $2.75, selling one of the January 75 puts at 75 cents. That $2 is my max risk. I break even down at 83 bucks, and I have gains of up to $8 between 83 and 75 with a max gain below 75. I've lost up to $2 between 83 and 85 with a max loss above 85. And here's the deal. I mean, as always, when I think about long premium directional trades, I want to be careful here, right? If the stock were just to go sideways or go higher, the premium that I paid for this is going to start to erode. It's going to go less. And I always like to use about a 50% mental stop on long premium directional trades, especially into events like this. Okay. But I am risking about 2.5% of the stock price. I have a break even down a little more than 5% or so. And I have a max potential gain of 9% of the stock price if it's down about 15% or so. And how I'm thinking about this, I know that seems like a lot, but that's about a month and a half or a little more or so. And I have this event, I have a very volatile rate environment, and I have very volatile economic data, to your point, guys, we're starting to see a little bit. I think if there's any hiccups on this, on margins, on some demand dynamics, on a whole host of other things, I think this stock could give up half of those recent gains. And if I pull up a chart here, I think we have another chart, kind of isolating a little bit. Well, here's the payout dynamics of this thing, and you can see where the stock has just been over the last month and a half or so. I'm risking 2 to possibly make 8 right over the next month and a half or so if I have a 50% retracement of this recent move. So I like the risk reward here. I like being contrarian here. And so to me, especially year end sort of stuff, guys, sometimes you get people going the opposite way if they have a couple data points, both micro and macro. And I think we could get some that would adversely affect at least investor sentiment towards the space.
The risk reward associated with this makes sense. I think you want to be somewhat north of 2.5 to 1.
Yep.
You're probably somewhere between 3 to 4 to 1 realistically if you nail this thing. 4 to 1 probably being the max, which you'll take that every day. So I like the trade setup. Again, we can talk about legging into things on another show, maybe get a little more advanced. But in terms of this trade right now in this sort of snapshot of time, I think it makes a lot of sense in earnings, and you're giving yourself through December into January in order to do this, which I think makes sense.
Yeah. All right. Well, we'll keep you guys updated on that, and we'll put all the details in the show notes for this trade idea. All right. Before we get out of here, we got to talk about gold, and we obviously referenced Bitcoin for a second here. You've been saying for a long time, Carter's been charting it. Okay. You think that someday we're going to wake up and we're going to see a new range established. It really felt starting late last night as the future started trading, guy, that this was going to happen here. And we had that breakout. It was a pretty powerful breakout. Maybe these guys could pull up a 5-year chart, and we've been showing longer term log charts and the like here. That breakout and the sort of, maybe they can show first that intraday reversal here. What does it mean to you? You've said that a lot of folks look at that. I mean, like, talk about a long-term consolidation, right? And that was on some big volume. And now if we just look at the intraday reversal, talk to us about, like, you traded gold for a long time, and you know how futures trade too, lots of stops and the like here. What does this sort of reaction mean? And then maybe they can pull up the 1 year again.
Well, I mean, you think about where we were at one point last night. I think at a certain point last night, depending on what service you were looking at, gold was up anywhere from $55 to $65, which is a move we haven't seen in quite some time.
Mm-hmm.
The reversal is extraordinary. Again, something I haven't seen since I was probably in the chair many years ago, and you can't dismiss it. I mean, the reversal that we're putting in seemingly is a pretty powerful technical signal that's not particularly bullish. I want to be crystal clear. What it feels like to me is there were buy stops that had been in the market that were triggered last night by whomever.
Mm-hmm.
You basically triggered those buy stops. It created a flurry of buying. Any, I don't know, let's call it tourist longs who were in it, took advantage of that. And then obviously you've seen the reversal. I'll say this. I think that's a snapshot of what can happen in the gold market moving forward. I am not at all happy about the price action today, but I'm not going to sort of throw in the towel on the back of this, although the technicals suggest that I should.
Yeah, well, and listen, again, it might have been like some players searching for stops. They elected them, right? So then that ends up being a big volume day, both to the upside, because once those stops get elected, if you're short, you're scrambling to cover, right? You know what I mean? Like, so there's a whole host of things going on there. Let's see how it trades in and around these levels, because this is the resistance levels where it's pulled back to a little bit. So, Guy, it's also worth noting though, on a relative basis, Bitcoin has not come in a lot. You know what I mean? And again, these are different risk assets, oftentimes bought for similar sorts of reasons. But I just think it's worth noting, and we'll keep an eye on that. We're going to be talking about Bitcoin a bit more as we get into the CME Bitcoin challenge. Last thing I want to hit, Guy, before we get out of here. You mentioned, okay, leading in economic indicators. You mentioned unemployment. So I just want to pull up Spotify. Spotify announces that they're cutting 15% of their workforce. Look at how the stock's trading, which is really kind of a sad commentary. Maybe they can pull up a 1 day or a 1 year chart here a little bit. Yeah. So look at that, right? That's the headline. That's it. Okay. Cutting jobs, cutting costs, working more towards, like a path towards profitability. What does that say to you? What are the incentives in corporate America to cut costs and cut jobs when you're rewarded like that in the stock market?
Well, I mean, how many times have we said with Elizabeth Young, EY from SoFi, that what you're going to start to see, and we talked about this months ago, is, and companies want to continue to hold margins in line, or even just get them to tweak higher, you're going to start seeing rounds of layoffs. And we've seen it over a swath of different industries. And although it's bullish apparently for the stocks, if you think about what it means moving forward for the economy, I don't think it's nearly as bullish, right? Job losses at some point, bad news will be bad news for the stock market. So we can champion these layoffs in terms of through the lens of the stock today. Yep. But to your point, keep in mind what story this is telling moving forward for the economy. Yeah, and again, it's not just Spotify. I want to be clear. Spotify is not the economy. Neither one of us are saying that, but it's sort of a narrative that we're seeing play out over and over again.
Yeah, and I just want to make one point, like when you think about Spotify, this is a company, we all know what they do. It's a recurring revenue business, right? Where they have people who are subscribers for their music, for their podcasting, for some other content. This is a company that's expected to do, call it $13 billion in revenue this year, 15.5 next year. So it's growing mid to high teens. Okay. And it is unprofitable. Okay. Net income on a GAAP basis, they're expected this year to lose $400 million and turn to maybe GAAP profitability next year. That's what the hope is. That's why they're cutting costs, to make sure they get there, and that Wall Street sees that. And that makes perfect sense to me. And listen, they hired a lot of folks in 2020 and 2021. So they're fixing that. Okay. Amazon did that. A lot of major tech companies, did that. Okay. So it's just interesting to highlight this. And just to put a point on this is that, Netflix, which is obviously the GOAT in the content subscription sort of business, they have 41% gross margins versus a Spotify that has 25%. So it makes sense that you want to get to a level of profitability and some of the aspirational peers that you have in the space. But it's just worth noting how the stock is reacting to this sort of news, Guy.
Absolutely. And we don't want to belabor it. We don't want to make it about, we're not saying Spotify is the economy, but again, you're starting to see it play itself out over and over again, that in the want to continue to show margin growth, or at least not show margin contraction, you're going to start to see layoffs, which is one of the reasons I think the unemployment rate going into next year is going to surprise people to the upside.
All right, fair enough. We covered a lot. We covered the rundown, Guy, and more on today's.
That's what we try to do. What we didn't mention is the fact that, the Rangers played San Jose last night. 6-5. This is the snobbiness of a Ranger fan. Typically, you'd be happy with the victory. I am not, because you don't want to give up that many chances. You don't want to give up many goals against a team that's clearly inferior. But you know what? Chalk up the wins while you can. Rangers still playing the best hockey in the National Hockey League.
I was watching this, the Alabama-Georgia game the other day, and I was at a sports bar, not something that you frequent too often, a sports bar,
I've never been to one.
But there's multiple screens going on there, and you would have literally been beside yourself, because we had the Alabama-Georgia game on. Then somebody was watching, no shit, the Cincinnati MLS game. I don't even know. It was like two teams in the Major League Soccer, and it looks like a couple high schools playing each other. I am not bullish on the MLS. I don't care about Messi or not. But there are some folks in there who were cheering that on. And then there was the Rangers versus Nashville. Okay. And that game was a great game. I mean, my right eye was kind of like, you must have been fine. Were you watching that on Saturday afternoon? Because
absolutely.
I mean, they were down 3-1 in the second and came back to win that game. So you must be loving how your Rangers are playing.
I'm enjoying it without question. You know, you don't win the Stanley Cup in November or December, but you build towards something, and the resilience of this team, I'm enjoying. And I'll say this, me at a sports bar. By the way, the NCAA really's got a hard on for Jim Harbaugh, because the fact that they threw Alabama into this Final Four and matched them up against Michigan, you know what they're thinking. Let's give Jim Harbaugh a lesson here. The fact that Georgia gets bounced out with one loss, Alabama gets in. It's all about, I guess, when you lose and when you don't lose. Florida State gets left out, and they somehow throw Texas in, understanding they're undefeated. I mean, it's a crazy confluence of events. The worst thing that could happen yesterday or Saturday, excuse me, for the NCAA was for Georgia to lose to Alabama and Florida State to win, and that's exactly what happened.
Well, listen, you know, this Michigan team is going to pound the hell out of, you know what I mean? Like think about that, okay? Well, no, I'm just saying they're going to do their best to do that versus Alabama. If they got them down, they're going to do that. And then Harbaugh going to win the national championship. Who do you think? It's probably going to be Washington. And then he just drops the mic. And where do we see him in the NFL next year?
Well, he definitely has his eyes on that. Although I do think he enjoys being at Michigan. I don't think he enjoys, you know, all the magnifying glasses that are seemingly upon him now. But I'm not certain that Michigan is going to beat Alabama. Alabama is playing well, and you could very well see an Alabama-Washington final, which if you watch that Washington-Oregon game, that Penix kid can throw the football. So that could be a fun national championship.
Well, it's funny, you know, when Harbaugh was with San Francisco, he got to the Super Bowl, lost to his brother, right? Didn't they lose to that? And then he left and he went to Michigan after that. I'd be hard pressed to see, like, he's got to win something, like you know what I mean? Like, for him to go back to the NFL, and if he does it, if he loses in the college playoff or he loses in the championship and he goes back to the NFL, I think he'll probably regret that forever, especially after the year that he's been through. That's just my 2 cents, guys.
Well, I'm sure our fans are loving us talking about college football and Ranger hockey, but that's it for today. Obviously, want to thank FactSet Financial Data and Analytics, powered by Tomorrow. We'll be back tomorrow. Who's joining us tomorrow? And let's throw up that CME challenge slide one more time. Yeah, get all up in there, people. The CME Bitcoin challenge, that'll be fun. I mean, listen, you know, more and more, I feel like, Guy, we don't have to debate like the merits of Bitcoin and blockchain and all that BS. You know what I mean? You can basically just think about it as a risk asset that's moving around, and there's lots of different products and ways to, you know, to trade it right now. So that one will be interesting. So check that out, people. All right, Guy, I think we've covered everything there is to cover. We'll see you tomorrow. I think Carter's with us tomorrow. So check it out. Market Call tomorrow, 1 p.m. Eastern on the YouTube. See you later.